Good afternoon, everyone. So this session is on finance for ophthalmologists, personal finance, a guide to being on target. So we have 4 talks. So we will be starting with Dr. Thomas George, who will be speaking on how much do I need as a corpus to retire. So I think after the talks and all, then we can have a session on the discussion and all later. So that would be much more better rather than
time
between.
at the end is
So by that, all the people will come so that we can have a discussion. All right.
Good afternoon, everybody. By retirement, what we mean is a situation where we do not need to work to earn financially anymore. It is not sitting back without doing anything for the rest of your life. So basically, you're losing, or rather, you're losing your interest in actually adding money to just survive. So, how much money should I save to be independent financially? Any financial calculation is subject to unknown risks, and like what you see in the mutual fund documents, past performance is not indicative of future performance, but we have nothing else to go by, so we have to look at past performance. So, it's for any investment, this is true. We all consider that banks are safe, but of late, if you've been watching the news, you've been seeing quite a few banks collapse and go into turmoil, and people having their deposits stuck and not being able to withdraw. So they're not 100% safe. They're safer than a lot of other things. So we need to estimate at best, because we cannot have a hard and fast number. Variables that we need is the present, first of all, is the present post-tax take-home income. Tax anyway we have to pay. So the money at your disposal is what is left after tax. So post-tax money is what you have to factor in as your income. And the other variable we need is at your present lifestyle, which you want to continue, what are your expenses? The present income over expenditure is what we need to know to maintain this present lifestyle for the future when we are not actively earning. It's not a mental calculation. Write in a book, a couple of months at least, you'll have an idea. Ideally, you should go through for the whole 1 year, because there are expenses that you want to have which do not come on every month. Like Onam and Deepavali are not there in every month. They come in different months. So you may spend more on those occasions. So once we have it written down, we can easily look at it and see what are the necessary expenses. In other words, what are your needs which you cannot let go of. Then there will be the luxuries, optional expenses, which would be considered as wants. Like, I want to take a holiday to the Himalayas, and that comes in as an expense. That is a want. You can do without it if you just want to survive. I'm not saying you shouldn't do it. Unwanted expenses. There are some expenses which when you look back, you say, I probably should not have bought that thing. And typically that happens nowadays with online purchases, because if we delay it by 1 day, quite often we won't buy half the things we buy on Amazon and things like that. So now you have a number to work on. Let's say you, for the sake of calculation, I'm just putting in a number. Let's say you need 50,000 per month to survive. And we need a date of planned retirement, at which time we should have enough money in the bank. So we retire at 60 years of age. Again, I'm putting it as an estimate. And if you are 40, now you got 20 years more to go to build up this corpus. So how much will I need to maintain that lifestyle at 60? This is a magic number that we need to estimate, and it is, like I told you, a guesstimate. So my grandfather told me when he got employed, his salary was rupees 27. His family of 6 lived on 16 rupees per month, and he used to spend 11 to his parents, and he could buy 2 sovereigns of gold every year from that 16 that he used to keep for himself. Well, that was in 1927, and the absolute purchasing power comes down as years go past, and that is the inflation rate. If the inflation rate is declared as 5% this month, what it means is the same month last year, if you could buy something for rupees 1, this year you need 1 rupee and 5 paise to buy the same thing. So inflation rate in India has averaged 6.02 from 2012 to 23 on averaging. The highest it has been is 12.17 and the lowest has been 1.54, but its average is around 6%. So let's peg it at 7% to be on the safe side. I like to overestimate inflation for calculating like this, hoping to be on the safer side. So if you need 50,000 now to survive, 20 years later, using the compound interest formula and an inflation rate pegged at 7%, you need 1,93,484.22, essentially around 2 lakhs for the present 50,000. So as a 60-year-old, you need to be able to withdraw 2 lakhs per month to maintain this lifestyle. Don't worry, there's a trick to doing it. Your return should stay significantly above compared to the inflation rate. Please consider the tax on the returns also when you're calculating, and please wait till later talks for a little more of this fund as to what to invest in. I will use a little bit of these topics to proceed further. Like suppose you have an FD. FD now gives just under 7% in most banks. Tax on the interest has to be deducted from this to see the growth, and suppose you are in the 20% tax bracket, it depends on which tax bracket you're in. So the effective interest now comes down by 20%, which means the 7% becomes 5.6. So it is under our assumed inflation rate of 6.02 that it has been averaging off late, maybe much below the 7% that we are using for calculation. It's not good enough. We need to find a way to make it grow above 8% post-tax to stay ahead definitely when averaged over the years. Retirement corpus is a concept where we create a nest egg amount that we plan to save to use for our leaner years, which will come when we are not actively getting a salary. Should be able to take bits out as we need it and not a bulk in one go. So it needs liquidity. Like if you invest in real estate, one, you may not be able to sell it at the time you badly need it. Two, if I got 10 cents of land, I can't sell 2 square feet at a time. Small bits cannot be sold, so real estate is not really meant as a retirement corpus. The remainder also will keep growing as years go by based on the investment classes that you have distributed it into. No real number can be perfect. Variables will keep varying, inflation rate will vary, return on investments can vary, and of course life expectancy, nobody knows how long each of us is going to live. Unforeseen needs can cause a bulk expense in between, but there are still some rough thumb rules that give us a rough number. My job is to tell you those thumb rules. We need a nest egg amount at 60. It will be growing with the investment. How much can you withdraw without ever running out? Let's retire at 60. We may live to 95 to 100 max. So we are looking at planning for 35 years, 40 years post-retirement. And we already talked about the present expense being estimated at 50,000. We need 2 lakhs per month. So the annual expense now is 24 lakhs at age of 60, 20 years down the line. This is one magic number we work on, and we got a few rules that are there in which are popular. One is the 30x rule, which is what most of the Indian financial magazines are touting. It just makes calculation easier. You need 30 times your annual expense expected at 60 as your corpus to retire. So 24 lakhs means you need around am I going back or forward? It's moving on its own. Sorry. I'm trying to go back. Okay. Anyway, we end up with a corpus requirement as around 6 to 7 crores. And how do you get to that? Consistent saving with a mix of investments that stay ahead of inflation helps. Remember to save before you spend, not save after you have spent. Quite often that way you'll have nothing to save at the end of the month. So you have to, at the start of the month itself, decide, okay, I'm saving 50%, 40%, 30%, whatever. And invest wisely what you save. It's not just enough to save and leave it in your pocket or the savings bank. So to get to these realistically, you need to save about 40-50% of your income. And what is the variable we can change? Go for a higher risk investment which will give you a higher returns. When younger, having more going into higher risk investment category is what is suggested. You can easily find your portfolio growing 15 to 20%. This is an international comparison of different countries. Nifty has, the Nifty index has given 21.5 returns percentage wise in 2021. It has been averaging 19.7 in the years before that. The calculation was from 1984 to 2021. The average is 19.7. It's about 20%. And this is a historical view of the Sensex. There was a great recession in 2008. And there was a big dip, but the very next year it's come back to what it was. So essentially the Sensex is giving around a compound annual growth rate of 15.91 or 16% is what Sensex is giving. So if your returns are going to be 7% with FD, you need to have monthly savings of 1,15,000, 10%, you need 80,000. At 15%, you need only 40,000 to get 6 crores in 20 years. Unless you're totally onto stock market, you're not going to dream any higher. But essentially, this is where you can adjust, and the compound interest will give you the returns over many years. Thank you.
Be taking it at the end of the session. Next, Dr. Prashop will be speaking to us on how much do I spend from the income as expenses.
Thank you for the opportunity. I have a request to the panel and the audience. I'm a bit jet lagged. I'm also hypoglycemic. I didn't get time to have lunch. So if I start speaking gibberish, please correct me. So let's begin. So it's an extension of Dr. Thomas George's talk on how much of my income do I spend, how much of it should I, the actual topic should be how much of it should I save. Now, there is a problem right now, and we have to recognize it because, and it is pretty acute right now. Now, Indians in general, when compared to the general population in the world, are considered to be historically really good savers. We like our savings. But in the recent past, what has happened is the Indians are saving less and borrowing more. And the latest statistics say that the savings as a percentage of GDP, net GDP, has come down to 5.1%, which is like lowest since 1970s. So it should be going up, not coming down. Now, what the economists say is this is probably because of inflation, but it is also because of our spending habits. To feed our spending habits, what we are doing is we are just borrowing more. We are using money that we don't have to buy things that we don't need. So that's what's going on now. And that's good for the economy in the short term, as in there's going to be a rise in the GDP figures in the short term, but in the long term, it's the savings that contribute to the GDP. So in the intermediate and the long term, it's actually very bad for the economy because today's savings are tomorrow's GDP. Now, this is a Western concept and not completely applicable to India, but this was explained by Elizabeth Warren. She was a former US Senator in her book. It's called the 50-30-20 rule. So it's the basic minimum. As Dr. Thomas George said before, the basic minimum is about 20% that you should save. But that may not be realistically enough in our conditions. We should be looking at figures closer to 40%. So out of the 50-30-20 rule, what is the 50%? 50% is a non-negotiable needs, things which you have to spend on. There is no way out of it, like bills, groceries, your transportation. By transportation, I mean the basic necessary means of transport. I don't mean a Mercedes. Rent, insurance premiums, debt repayments. I mean, once you are in debt, it becomes a need. You have to repay it. So those come under the 50%. So you should divide your income into 50, 30, and 20, and 50% should be on the necessities. 30% for the wants, for the luxuries. No, you like to live a lot. We all like to live our lives. We don't want to be, totally stingy. So 30% are for your trips or your holidays, your luxuries, you're eating out at restaurants, the Swiggy that you order. For your subscriptions, your Spotify, Netflix, Amazon Prime, etc. Your flashy clothes, bags, jewelry, the latest iPhone, the luxury cars, gym memberships, and gifts for things like birthdays and festive celebrations. So they come under the 30%. They should not exceed 30% of your income. And this is the most important point. It comes at the last, but it should be actually in the beginning. This, as I said, is the bare minimum, and it's extrapolated from the Western societies. Probably the figure is closer to 30 or 40% in our case. But at least 20% of your income should be in savings. And out of the savings comes the most important part, emergency fund. You should have a certain amount set aside for emergencies, which can vary between 3 to 6 months of your income. Because if you are ill or if you have an emergency, you should have backup income to support you during that period. So have an emergency fund. That should be part of the 20% savings. The rest go for investments, as Dr. Thomas George said, mutual funds, stock markets, fixed deposits in inverted commas, and retirement schemes. You could also consider paying off your debt early and closing your debts early. That also can come under this bracket. But before you apply the 50-30-20 rule, you should know what you earn. So what you earn, what your salary is, the gross salary is not what you earn. What you earn is after taxes. So you should know what your taxes are and what your final income is after deducting taxes. It needs a bit of effort in the beginning to know what tax bracket you fall in, what are the tax savings you can have, what are the ways to reduce your tax burden. But if you overcome that, then it becomes easy. It's just the initial effort that you need. But again, if you don't have the time for it and don't have the inclination for it, you can, of course, outsource it to a good financial advisor. And by good financial advice, I mean good. There are a lot of spurious financial advisors out there who will take you for a ride, and who may enroll you in schemes that you don't want. Then this is another important aspect of savings. It's to track your budget. We may think that we know in the back of our mind, we know how much we are spending, but no. We all have this inherent bias. We tend to minimize our expenses and maximize our savings. So in our mind, our savings are magnified and our expenses are minified. The only way to get an objective idea about this is to track it. Simplest way is to make an MS Excel sheet if you are into that. Or there are so many apps available online on your Android phone or your iPhone, which you can use to track your budget. There are many banks, actually. The way I do it is my bank has an app which allows me to, I spend all my money from one account. So the bank tracks my expenses automatically, and at the end of the month, I get a pie chart where I spent what. So tracking your budget is important. Again, identify your needs. Obviously, your needs should be your absolute needs. What are not needs are dining at a flashy restaurant, ordering Swiggy while watching cricket. That is not a need. Those are wants. So don't confuse your wants and needs. And sometimes a want can become a need. Suppose you decide to buy an expensive, say, a phone or a car, a flashy new car, and you buy it on EMI. Once you've done that, the EMI becomes your need, something which was a want comes into your 50% need bracket. So try and avoid doing that, but once it has happened, then it becomes a need. Again, another area of controversy, do you need your own house or is renting better? Now for many Indians, owning a house is an emotional investment. So in that sense, it makes sense. But do you want to own a house as an investment? That's a matter for another day. Savings, that is the most important, as I said, the 20% bracket. How much time do you have to devote to your investments? Are you really financially savvy, or are you extremely busy? Do you have enough time to look at where you're going to invest? If not, simplest way is to automate your savings, start an SIP. Mutual funds are generally safer. I'm not saying they are the safest. They are generally safer than directly dabbling in the stock market. But if you are confident, if you know your ways around the stock market, please go ahead. But it's not possible for all doctors who are really busy with their professional lives. If you cannot do it yourself, of course, outsource to a good financial planner. Again, what's important is consistency, setting realistic goals. You need to have certain goals in your mind. For example, retirement. You want to buy a home, or you want to fund kids' education, and have realistic plans. So you can't be earning 20,000 rupees a month and wanting to buy a mansion. So be realistic about it. Formulate a plan, and the important thing is to stick to it. Now, why I showed Jack Ellis here, anybody knows why? Because he's considered one of the most consistent cricketers ever. Very underrated, but he is. So if the plan is unviable, always switch to a plan B, or be open to re-evaluation. And this is very, very important. When you have emergencies, you should have the emergency fund and make use of it. But once you made use of it, replenish the fund in your next proper income. And change plans if needed. If push comes to shove, you will have to change your plans. And you obviously cannot take from your 50% needs. Reduce your wants. That's something that you can do in the short term when you are in a pinch. And again, don't neglect your wants either, because life is to be lived. You should not neglect it completely, but beware of the hedonic treadmill. What the hedonic treadmill is, you get to a certain stage of happiness, and it satiates you, and then you need to get more to feel more happy. So don't get on that treadmill. Be very conscious of that. Thank you.
Thank you, Prashop. That was very clear and succinct. And now we have Dr. Biju telling us where to invest, the different investment possibilities, and overview will be given now.
Yeah, thank you, Thomas, and KSOS for having me in this IC. So this is my topic. So I was thinking how to cover this, and I thought of just starting with a story, and I got the story from the unlikeliest of the source. That is from the Bible itself. Yeah, this is something which everybody knows. Jesus Christ was telling this story to his disciples, this parable of the talents. So you know about that merchant who went for a long journey, and to his 3 servants, the first servant he gave 5 talents, the second 2 talents, third 1 talent. So he came after a particular time. Time is not mentioned in Bible, but after a well-known research, it has been concluded that it is 6 years, considering the Jewish economic cycle. So let us say 6 years. So then what the servant has done with the money? So this is what has done. The first servant has managed to double it. The second also had managed to double it. They were suitably rewarded. The third one, he said that he was very afraid that he will be losing his money. He was afraid of his master. So he wanted to put his money absolutely safe. He dug a hole in the ground and just put the talent there. So that is it. So the first two servants was rewarded handsomely. The third one, as said in the Bible, he was banished to a place of darkness where there was gnashing of teeth. Now, when I was teaching this in the Sunday school, they asked me, that was really unfair of God, you know. After all, what he did was just to keep the money safe. So it could not have just punished him. Actually, I didn't know the answer that time, but now I know the answer. There was no punishment by the master. It was a self-inflicted punishment, because by the time the third servant reaches his retirement, as Thomas has already told, now that one talent would have reached 1/4 its value after 20 years. Why? That is the punishment, because of inflation. So he would not have enough money even to pay his electricity bill. So he will be in darkness. Okay. So now we have got 4 investment lessons to learn from this parable. That's what I'm telling you. So let us say the time was 6 years. So the first 2 servants, doubling of the money. So this is the returns that they were, basically getting, 12%. How did we get that return? You apply that simple rule of 72. Just 72 divided by the interest rate gives the number of years which is needed to double the principal investment. So that gives 12% returns. So that is the first lesson. The investment need to beat inflation. Thomas was again telling that. And last 10-year average return, average inflation rate in India was 6%. So you need to have some sort of investment which should beat that. Now just compare it to your average FD, which is about giving you a return of 7% now, doubles in 10 years, you are still not beating inflation. Okay. Second lesson, the time of investment, it has to be long term. Long term means that at least 6 years or above. Again, the 6 years time here in the second lesson. Third lesson, were the servants given the money equally? No. What Bible says is that to each according to his ability. So that is why the first servant, the master identified that he was the top performer. So he was allotted 62.5% of the amount. Okay, the second one, not that reliable, but okay, 25%. Third one, he was taking a risk. So he knew that there is a chance that he is going to lose the money. That is why he gave him only 12.5%. And this is what is referred to as asset allocation. Asset allocation is the cornerstone of investing. This means that distributing your investable surplus across the asset classes, such as equity, debt, gold, real estate, or even cash. The focus is that you are just balancing and reducing the risk through optimal diversification of your entire portfolio. In simple words, don't keep all your eggs in the same nest. That's it. And the fourth lesson, what did the master do on return? No, he just, took that one talent and gave it to the top performer. Okay, so that is about reassessment and reallocation of portfolio. So just go and have a relook at your portfolio, identify the non-performing assets and reclassify. Okay, so that is about the asset allocation and all this. Now these are our different investment options that we are having. So I will just talking about a few of them. Now this blue thing that you're seeing here, oh, the pointer is not here. Okay, that blue, okay. So this is the inflation line. Okay, so we are talking about all the type of investment which are giving you returns above that. That only matters. So the one which is giving you 7%, that can be taken off the first servant. There is only one guy here. That is the stock market. Okay, so it gives you on an average 7% above inflation. That is the minimum if you know how to invest it in properly. So that is about the first servant. The other ones, you can see the fixed deposit, the bonds, gold, real estate. So these probably you can take them as the second servant. So here they just managed to beat inflation. And then you have got, of course, third servant, that is your savings bank. Now many of you will be keeping it in savings bank. But you can look at the return. It just gives you 3%, which is almost less than you are losing money there. So you can see that as the returns increase, the risk also increases. That is why you need asset allocation. You need to diversify. And there are a lot of things here which are given. There's no time for going into that, but these are also there. But we don't have time. Okay, these are other factors to consider when you are allocating, that is your short-term and long-term goals and your financial needs also. Now, regarding stocks, anyway, all of you know that stocks, it just means that there's a share or ownership of the company. Somebody buys it either during an initial public offer or from the market. If the company is doing well and if the guy is keeping the share, you get the returns in the form of dividends if the company is making profit. Again, if the company is making profit, the share price increases, and if we just sort of sell it in the market, you make a profit. So that is the return that you get from the stocks. On the other hand, if the company doesn't do well, then you make a loss if you sell it. So this is essentially what is stock. Now, thing is that there are two ways of investing in equities. One is by direct investment. That is, you just open a demat and a trading account through a stock broker and get started. Now, this needs a lot of time and effort. You need to read a lot. You need to do stock screening, research of stocks. You need to listen to financial news, etc. So this is something which, a minuscule percentage of us will be doing. So the most of us, what we can do is the indirect investment. That is, you just give your money to a particular asset management company. So they will be collecting all this money, producing a large corpus. And they will be buying shares for you from a large portfolio, because there's a lot of money there. So these are your mutual fund managers. So these are basically you are giving to the mutual funds and they will be investing for you, and these are mutual funds. But problem, of course, then you need to give them commission. There are expenses, entry load, then fund management fees, etc. will be there. The second option would be to seek the service of portfolio managing services. They will be professionally investing your money in either mutual fund, shares, real estate, things like that. But as Prashop said, you have to select your portfolio management very intelligently. So these are the two methods. Now, if you look at the mutual fund, there's a whole variety of all these things. There is no time again to go through each and every one of this, but basically you can classify it into large caps, mid caps, small caps, depending upon the capital which is the wealth of the company. So basically you can say the large caps would be safer. Now, just go through this chart. This just shows the appreciation percentage from 2016-2023 of a few companies. This is the graph of how the share of Reliance has gone. You can see that it has gone almost appreciated about 347% from 2016. However, for the last 1 year, there is some amount of negative returns. The same is the graph of the Infosys also. And on the other hand, you can see that the Yes Bank here, it has had a meteoric rise initially, but somebody who has invested in that has lost 90% of his money now. So, this is the vagaries of stock market. But just see how the Nifty 50 has fared. It has had a smooth rise here, almost giving you 157.4% of appreciation without much of a hiccups. So, you can ask, if Nifty 50 tracks the share price of the top 50 blue chip companies in India. So can somebody sort of buy all these companies for me? Sure, they can. So there are mutual funds like that which tracks the performance of these companies, and these are called index funds. So it's a very good option for people who are not very savvy about this index investing. It's a fail-safe strategy. How much equity should you invest in? Use the 100 minus age rule. It means that you should hold a percentage of stock that is equal to 100 minus your age. If you are 40, you should hold 60% of your portfolio in stocks. The rest should be in debt and fixed income securities like that. And the way to invest in equity is by using SIPs or STPs. Again, there is no time you have to actually read up that. You don't have time to go in details. Now the other investment, so the FDs, lower risk, lower return debt investments. FDs, RDs, tax shelter deposit, these are things which everybody knows. But bonds are things which you are not very familiar with. This can actually give you a slightly more return than the FDs. So how do you invest in bonds? There are online sites like this. And by indirectly, you can also opt for debt, mutual funds and ETFs, etc. Real estate, of course, the liquidity problems is there, as Thomas was telling, but you can look at these things here. There are real estate investment trusts, then infrastructure investment trusts whose listed shares are available for you to purchase, and it gives you a good option, at the same time not wrapping your money. Gold has always been a protection against inflation and deflation, gives you reasonable returns, and it is something which gives you true diversification, which means that it goes sort of opposite to what the share market is going. Okay, so finally, now this is something. Now I haven't understood anything of this. I'm a novice, don't know stocks, don't know mutual funds, not ready to spend time researching them. I get confused when agents approach me with all sort of mutual fund investment scheme. I don't trust real estate. What should I do to get an annualized return of 12% per annum after investing for say 6 to 10 years? If you are somebody who is asking this question, then my personal answer is this. Start investing by putting your 110 minus age percentage of your investable amount in a Nifty 50 index fund on the 13th of every month. And the remaining FDs and gold. Why 13th and all? Probably we will discuss if I get the question. Thank you.
Yeah. Thank you, Biju. You kept it entertaining as well as very educative. Thank you, Biju. And now we have Kiran telling us about how to protect yourself, insurance, and what is the need for it. Kiran, please come on.
Yeah, insurance. Why do you need it? I don't look like an insurance agent, but so insurance is basically financial compensation. It's three components. One is financial compensation to either yourself or your dependents. When you have contingencies, it could be death, disease, accident, disability, anything. So depending on what contingency you insure for, you have a variety of insurances. The first three are probably the most important for everybody. The third one specifically for doctors, which is malpractice insurance. And there are a lot of other insurances, property insurance, fire insurance, public liability insurance, and some insurances like car insurance, third party, which are all mandated by law. So we will be discussing only the first three, and we'll go into a little depth. We'll start with life insurance. So life insurance, if you go back to the first definition, is a financial compensation to dependents in the event of your untimely death. So all these are very important terms. So when you look at life insurance, you hear a lot of these different plans. And most of the plans that your friendly insurance agent in the former years, they used to be called the LIC uncles. The LIC uncles will promote what are known as endowment plans, ULIPs. They will be couched in different names like kids saving plan, if you have a female child, marriage plan, and whatnot. Because the attraction about these plans is that they give you tax-free money at maturity, right? But on the other hand, term insurance will not give you any money at maturity. But the fact of the matter is the only insurance that you actually need in life insurance and the only insurance that can provide any adequate coverage is actually term insurance. But the insurance agents will not sell you this because they hardly get any commission out of this. How much life coverage do you need? You have to think for yourself. If you are the only breadwinner in the family, if you have an untimely death, generally your dependents will require at least 10 to 15 times your annual income plus all the liabilities that you currently have to take care of them, right? So, just imagine your annual income is around 25 lakhs. That means by the earlier calculation, you will require something like 2.5 to 3.75 crores as a lump sum amount of money to be paid to your dependent in the event of your untimely death. Let's look at this example. 40-year-old, healthy, non-smoker, assuming it's a doctor, coverage required according to the previous calculation is around 3 crores. And you are using this term insurance till 65 years of age, right? So if it's a term insurance, your annual premium will be around 50,000. So if you pay 50,000 per year from 40 years to 65 years, in the event of your death, your dependents will get a coverage of 3 crores. Now, for the same premium, if you are using an endowment plan or a ULIP plan, you will be getting a coverage of 5 lakhs. Just think of this. Because here the attraction is not the fact that you will only get 5 lakhs, it's just that you will get a lump sum after 65. right? But it is basically an investment plan. The endowments and the ULIPs which are generally sold to you are investment plans. They are not insurance plans in its pure sense. If you want to cover your dependents, you should take a term insurance where your dependents will get paid a lump sum amount of money at a relatively low premium for the amount of coverage required. But because these relative premiums are very low, there is hardly any commission. Insurance agents will not tell you this. How long should you take term insurance for? It's very simple. Until you have dependents or until you have accumulated a corpus large enough to take care of your dependents. Typically, let's say 60 or 65 years. There are some term plans that are being sold currently till 99 years of age. It is ridiculous. Don't take it. I have a huge corpus already. Do I still need life insurance? No. Let's say my annual income is 25 lakhs and currently have a nest of 50 crores, whether it is part of my investment or what I have received from my parents, that is good enough to take care of my family. I don't need any life insurance. Now, coming to health insurance. Again, financial compensation to yourself or your family, that will depend on what kind of health insurance you take. If you take individual plan, it is for yourself. If you take what is known as a floater plan that covers all the members of the family, it's for your family. It is for hospitalization and daycare. So, this is again a basic principle. In health insurance, always try to take what is known as a base plan plus a super top-up plan. Okay. So, I will explain with an example. 40-year-old non-smoker, no systemic illness or PED is pre-existing disease. This is insurance speak, PED. So, we need a health cover of suppose say 50 lakhs, and that sounds a lot of money, but if you get admitted in the ICU for a few days, lakhs will just flow away like that. And here there are two options if you want a coverage of 50 lakhs. Or you can either take a base plan of 50 lakhs. You take a single plan that covers you for 50 lakhs. That will be approximately around 40,000 premium per year. Or you can take a base plan of 10 lakhs and a super top-up plan of 50 lakhs. What it basically means is that if you get hospitalized and the total bills say come to around 20 lakhs, the base plan will pay out the 10 lakhs. The super top-up plan will kick in only after your base plan is exhausted. And because in terms of probability, the chance that a hospitalization is going to cost you more than 10 lakhs is very less. And there are very less chances of super top-up plans kicking in. Therefore, the premium is actually much lesser. For essentially, for a coverage of 50 lakhs, you will have to end up paying a much lesser premium as I have shown there when you use this in combination. Generally, opt for plans with no sublimits on room rent or ICU, even if it is at a slightly higher premium. I've seen and various examples where you can, for example, develop a heart attack at a time when there is a dengue outbreak and there are no beds available except the suite rooms or the deluxe rooms. And then you don't want to get into a hassle of having a plan with room rent limits, ICU sublimits, etc. Just even if it is a slightly higher premium, opt for such a plan. Important to check the policy coverage of prime hospitals in your locality, in the sense that you shouldn't take one insurance which gives a lower premium simply because it's a lower premium. You have to make sure that all the major hospitals are covered in their network. This is important because the only way you can get cashless claim is only in the network hospitals, right? And this is important if you have a large expense. Now finally, there are so many other things, we'll just stick to only the basics. Finally, malpractice insurance is also called as professional indemnity insurance. It's basically financial compensation if the court awards a financial compensation and the legal expenses, which is the amount of money involved, it is paid to you when a court finds you deficient in your professional service. Right? So, malpractice insurance or professional indemnity insurance is essentially offered by one insurance companies, mostly private insurance companies, but it's also offered by the Indian Medical Association, which is called the PPS or the Professional Protection Scheme. The Professional Protection Scheme technically is not really an indemnity insurance, it's a more comprehensive insurance. It generally has a lot more advantages than the insurance that is given by the private insurance companies. So they are much more experienced, have a vast data bank, they have lawyers who have been doing this for a long period of time compared to the private insurance companies. And well, in private insurance companies, a lot of time you have to find the lawyer yourself and you basically deal with yourself and the legal team. That's not the case with PPS. And PPS also usually with exceptional circumstances only, they allow for any payoffs or settlements. And also, depending on the high risk category, you don't have to pay extra fee. For example, if you are an ophthalmologist compared to somebody who is not in a surgical field, you might have to pay higher premium with private insurance companies. If you are a gynecologist, you will have to pay a very high premium. Or if you have a claim this year, you will have to, the premium will get loaded much higher next year. That is not the case with PPS. So, eligibility, only the life members of Indian Medical Association can be part of VP scheme. The scheme covers all cases filed in all these different formats. It's also important to note that if you have a medical legal case against you, if the opposite lawyer knows very well, he will file case again in all the courts, criminal court, civil court, human rights commission, consumer court, everywhere. So you will need to fight in all these areas, and that's what PP scheme does. As far as the jurisdiction is concerned, the traditional PP scheme is only in jurisdiction is within Kerala, but there is also a national PP scheme which will cover throughout India. And this is essentially the fee structure. It comes to around 1,500 by year 6, and that is how. This will cover about 10 lakhs per case or 20 lakhs per year. And in some cases, we know that this is not enough. For you can take what is known as an enhanced protection, where for an extra 10,000 per year, you can get coverage up to 1 crore. For the professional protection scheme, with national PPS, it will cover only up to 50 lakhs. So some general principles before I conclude. You keep your family members informed. It's not enough that you take a huge coverage of life insurance. You have to keep your family members informed of not only the policy documents, if possible, if your dependents are financially illiterate, get them a list of fee-only SEBI-registered financial planners. You can get it, fee-only SEBI-registered financial planners. Because once you get a lump sum of 5 crores, they need to know what to do with it. Full disclosure at the time of taking insurance. Do not hide any pre-existing diseases or anything. You will end up in trouble later on. Insurance is never a substitute for investment. You should not club both of these. That is why you take term insurance and do your investment options in other mechanisms. And keep it as simple as possible. You will have, whatever insurance you take, you have so many riders, critical illness riders, terminal illness riders, and that benefit, this benefit. Usually all of them are market speak. Keep it as simple as possible. Thank you.
Thank you, Kiran. That was very well done. We are sort of running out of time. Does the audience have any question to ask us? Okay. Yeah.
Malpractice is a term when you are found guilty of malpractice. That is what. Sure. Yeah, the social security and family, I don't have much knowledge about it. I know that the social security schemes of the IMA are reasonably good, but it will not cover term insurance because the amount of money you get paid at the end is very less. Family benefit scheme, I would really need to look into it a little more. Sorry.
Okay, both these are contributory schemes for fraternity death, and if you actually sit and calculate it against the term insurance, it comes out to be about the same. But I would suggest that everybody joins the FBS, SS, Kerala IMA has got Social Security 1, 2 and 3.
Yeah, SS 1, 2 and 3, the problem is the net amount of money you get is really not good enough in terms of your overall corpus. I mean, that's what I'm saying. If you are earning 25 lakhs a year and if you are the only breadwinner in the family, you will require something like 3-5
All 3
crores.
will give you 50 lakhs.
Yeah, but we are talking about 3 to 5 crores bare minimum for a 25 lakh earner. So that is why the social security schemes will not cover the total corpus required.
Dr. Biju John, I have one question to you. You are actually talking about the financial planners and all. Most of the people who are sitting over here won't be knowing much about the Nifty 50 and the other things and all. So as for youngsters and all, once they start the financial planning and also now the SEBI has told that actually that when you have to join for the PMS investment and all, actually the minimum amount of fund which you require is like 50 lakhs, which won't be possible with youngsters and all. So how can you help the youngsters? You have told that, okay, you should start. Everyone was telling that we should start early, like 25 years or 30 years and all. So then how can you start doing it?
That is the advantage of the SIPs. The best thing would be to join a SIP. So you can start a systematic investment plan with as little amount as just 500 rupees. So there is no upper limit also. And the basic thing is that you just enter into the stock market only by small tranches, not as a lump sum. So that basically in Nifty 50 or any sort of stock as Sensex, it just goes, but then it has got vagaries. It just goes up and down like that. But historically what we have known is that it has always cut above its peak, goes above the peak. So there will be areas where it just comes down. So in order to make sure that you don't end up as a loser by investing at a peak time, putting a lump sum at the time when everybody is telling that the market is going crazy like that, now put amount, and then the next year you find that you are losing money. So just not escape that, you make sure that you just keep small amounts like that and go on. So that way there will be something known as rupee cost averaging. Because even when you have got a Nifty crash, it means that the same amount of money you are putting in will be getting you more stocks. All these stocks will have got the potential to rise again. So that is the advantage of joining a SIP.
What about the sovereign gold bonds and all? Sir, can you just tell about the sovereign gold bonds?
Okay, Biju said gold is good to hedge. Physical gold, there is a problem about, if you're looking at jewelry, there's a problem about purity of the stuff that's given to you. Gold bars, they're more pure, but it can be stolen. So you have the option of gold ETF, that's like a mutual fund, exchange traded fund, or sovereign gold bonds, where you do not have the gold in your hand, but you're investing in gold, and the price will track the price of gold, and when you give it back, you get the returns. Sovereign gold bonds, in addition to this, gives you 2.5% returns per year. Per year or 6 months? Per year. So that is an extra bonus. And so the best option is sovereign gold bonds. But the problem is you got to buy it in bulk. Whenever it's up for offer, you have to buy it in bulk. So you need big amounts of money. If you like the SIP 500 rupees, you can go into the gold ETF, exchange traded fund, which is again a non-physical way of holding gold, and that can be in whatever money you got to spare, you can put in there.
One issue with sovereign gold bonds that is not discussed is that they are for a specific time period, for 7 years. So there is a problem there, because say you are buying bonds today, gold bonds today, the final amount you get will be exactly the amount that is of gold at 7 years from now. If you track the returns of gold, it may not fluctuate as widely as the stock market, but it also still fluctuates. There are periods when it is high, there are periods when it is low. So you can end up in a situation where at the 7th year, you might actually get very low returns because its liquidity is very low, because it's for, you can sell it in the secondary market. Secondary market liquidity is still not very huge for SGBs, but I mean,
Kiran, it's for 8 years.
8 years.
If you buy it from the government, but now you can, because I buy them on ICICI Direct.
You can basically sell it on the market.
Yeah, and
Secondary market.
And you get, because everything is priced in now. Because initially the liquidity used to be quite low.
Quite low, yeah.
But now even the interest is priced in, depending on the which tenure bond you are buying. Everything is priced in, and you can buy it even in 1 unit increments. You don't need a huge sum.
You don't need money.
You can buy in 1 gram increments.
My only issue is that unless you sell it in the secondary market,
Yeah,
then it's
and
like
one point I think, and if you hold it till redemption, it's tax free.
tax free. Yes.
All the returns which you have accumulated, there is no capital gains tax compared to an ETF, gold ETF, where it's the net return is taxable.
This question is to Dr. Prashop. See, how do you stay informed about the personal finance matter? Can you just tell the audience regarding the websites or the apps which can actually help you?
Yeah. Sorry. So I had mentioned I don't remember all the apps by heart because right now I don't stay here. I stay in the UK. So there are apps that I use there. But there are specific apps that are, if you just Google, you'll get it. For tracking your expenses. It's very easily available. Even some banks let you track your own expenses. Okay. Yeah, I think we are running out of time here.